So we'll start off with the challenges and risks, but don't think of me as, as incredibly pessimistic, because I do think there are tremendous opportunities out there, and we'll get to those in just a second. So the first one is inflation, and inflation continues to be high. We're seeing wages remain stubbornly high, which means that people have money to spend, which just naturally drives prices higher. We're also seeing still some strength, or strength, if you want to call it that, higher prices when it comes to shelter. Now, this is an area that is waffling a bit. Rents for some apartments are coming down, while prices for homes are still relatively high. But the fact that we have high interest rates makes mortgages difficult if you're buying a new home. So there's some ambiguity when it comes to inflation, but it's still very high, and it's still a major concern. So this week's job market report will be very important. On Friday, we're going to get information about how many jobs were added to the economy in February. Now, you remember when we had this call last month, we were kind of taken aback by how strong the January numbers were. So now we're going to be watching these February numbers really closely to see, was that just an anomaly, or are we really facing a stubbornly strong job market? So if the economy added a whole bunch of new jobs that we weren't expecting, you can expect to see some weakness in the overall market, because what that tells us is that the Fed is not doing a good enough job of tamping down inflation, that the employment level is too high, that people still have money to spend, and they will keep driving inflation higher. So the market is probably more focused on what the Fed's going to do than they are on the good news of adding new jobs. Now, so jobs are good. We definitely want to see people employed, but because they add to inflation, that causes a risk for the market. Now, this morning I actually heard an interesting take on jobs, and I think it's worth thinking about. Powell is basically focused on trying to cause layoffs, or at least cool the job market, which is supposed to keep people from spending money and help to drive inflation lower. But what that actually can do in some cases is, if people are laid off, it hurts companies and their ability to produce goods and services that we need to buy. So it could reduce the amount of supply of things that we want. Meanwhile, when people get laid off, they typically have severance packages, we have unemployment insurance, we have other ways of making sure that, and we should, to make sure that people aren't hurt individually terribly when they lose their job, and to give them a little bit of a safety net and a way to get back on their feet. But what that does for the economy is it means that people still have money to spend even if they're laid off, which completely turns that whole idea of layoffs reducing inflation on its head. Because if people still have money to spend and businesses aren't able to create as many products and services that we need, that just causes inflation to be even higher. So there's some argument to be made that we're shooting ourselves in the foot to some degree with this focus on bringing employment lower. So something to keep an eye on, and definitely watch very closely. Interest rates are incredibly important in the market that we're in right now. The Fed continues to talk a big game, and this week, even as we're talking right now, investors are reacting to Fed Chairman Powell's testimony in Washington right now. So he is going before Congress and telling them what he expects, and he's getting questioned, and it's a whole dog and pony show. But what we're seeing from this is that Powell is still very, very focused on raising interest rates to cut inflation, and the market doesn't like seeing that. So we saw a big pullback in the market on Tuesday, and the jury's still out on what that long-term trend is going to be, but it's a risk that we need to keep in mind. So the next Fed announcement is going to be on March 22nd. And the big question is, will the Fed raise by 25 basis points, 0.25%, or will they go a little bit stronger and raise by 50 basis points? And then more importantly, we need to think farther down the road. What happens then? Is the Fed going to keep raising rates aggressively? If so, that's probably going to put a lot of pressure on the market. Now, we've talked a lot about how higher interest rates hurt different areas of the market. But one of the things that they do that we haven't really talked about is now we're looking farther and farther down the road to see higher interest rates. And when you have higher interest rates, it makes it more difficult for companies who have debt to refinance their debt. So most companies have bonds that are scheduled to mature in, a few years from now. So if you have $500 million that is you're supposed to repay in maybe late 2024 or early 2025, the company has to come up with that money to repay its bondholders. Well, typically what happens is that that loan is rolled. So the company will issue more bonds. They'll pay whatever the interest rate is then, and they'll get the money from those bonds and they'll pay off the existing bondholders. Well, that's all well and good when interest rates are stable because the company can borrow money at the same price or at the same interest rate that it had before, and things just keep on going as they have been. But now, with interest rates moving higher and expected to stay higher for years and years to come, many companies are going to have a really hard time refinancing that debt. And that causes some risks in two different ways. On one side, we know that companies that are unstable, or companies that are kind of on the verge of being profitable or not profitable, those companies are going to have a really hard time, and we could see defaults pick up. That's a risk that a lot of people are talking about, and that we know we need to be very careful about investing in companies that have too much debt. But the other thing is, companies who are solvent, companies who are profitable, who can very easily go into the market and raise new capital, they're still going to have to pay higher interest rates than they were before. So what that does is it causes us to look farther down the road and say, well, they're not going to make quite as much profit as we expected. They're still fine. They're still going to generate income. They're still going to pay their dividends, but they're not going to be quite as profitable, quite as healthy as we expected, because they have to pay higher interest rates starting in 2024, starting in 2025. So as we see investors start to kind of recalibrate what they're expecting down the road, that could cause expectations for profits to come down, and it could cause many of the stocks that we still like to pull back, or at least not move higher as quickly as we expected before. So it's definitely a concern to keep in mind, and something that we'll be watching very closely and let you know which companies have the most risk here and also which companies don't. And so capital is likely to move into those stocks and help drive them higher. And then another thing on the debt side that we want to focus on is that consumers are dealing with debt in different ways. So I saw an article recently over the weekend that said that consumers in their 30s now hold $3.8 trillion in debt. So this is the normal working families who have 2.4 kids in a house, a two-bedroom house, and they're dealing with just a huge and growing level of debt because inflation is hitting these families really hard. And so these families are going to be looking for value. They're going to be trying to figure out how to stretch their budgets and their investments that actually can benefit from the way that these families are spending. At the same time, affluent consumers actually have a lot of money. So if you look at the big picture of all consumers, there is a lot of savings that's still pent up that was saved during the pandemic and is now ready to be spent. And one thing to keep in mind is that since we've had a stock market rally so far this year, those consumers who have money in the bank will feel more confident about spending that money because the market is higher. They're seeing their investments rise, so they don't feel like they have to keep that money in the bank as a safety net anymore. And that's going to drive consumer spending on more affluent things. So travel, some more expensive luxury type items. And that's another area for us to keep in mind as investors.